Assalamu alaikum and good morning to everyone. My name is Dr. Lokman Hakim Osman, and today I'm going to be talking about the financial aspect in small businesses. Now, the objective of this lecture will cover these four main items. Number one is to identify the source of financings. Number two, recognizing financial institutions for small business support. Number three, to understand the needs of financings. And number four, how to prepare a proper financial plan. Now, in financing your businesses, there are several items that you need to clearly understand, and it involves initially to understand what are the needs of the financings. Consequently, you need to identify the type or source of financings that meets the needs of your businesses. Third, what are the financial institutions that can meet the needs and support your small businesses? And then preparing the financial plan. To understand the needs of financing, there are three elements that reside under this initial objective. First, you need to understand and identify what are the production costs or the product costs involved in producing your product or services. And then to understand, to calculate what are the break-even analysis and the total capital needed to operationalize the businesses. Now, a project cost can consist of several components. It may differ from one business to another, but it lies within 6 to 7 main concepts. Number one is the establishment cost. Number two, what are the professional advisors costs involved, such as legals, accounting, website development, graphics. Third is the licenses and registration costs. Number four are the plant and equipment costs, which can be inclusive of computer equipment, vehicles, mobile phones, and some of them can be fixed, and some of these plant and equipment costs can be variables. Number four is the business premises. This is the entities that you use to operate your business in, and it can be in the line of what are the monthly rents of your business premises, the lease bond that you need to spend to start renting the businesses, the legal fees involved in making the lease ready, insurance. Number six are the operations costs, which means the activities involved in operating the businesses. Well, under the operation cost, you see that some of the items can be in the form of wage and salaries, contingencies, the initial working capitals, and all of this will made part of the what we call the establishment costs. These are the definitions that involved in what we call two most important costs in productions, in the creations of production costs or the total costs. Number one are the fixed costs, which the fixed costs are the costs that you have to pay whether or not the business is operating. You still have to pay for it, and an example of fixed costs includes the fees or the rentals of your businesses, whether your business are making money or not, or the business are operating or not. You still have to pay the rent of the premises that you have signed the lease on for like one year or whatnot. And then we have the variable cost. This variable cost is the cost that varies with the level of output. Now, the more you produce, the higher will be the variable cost. and the variable cost will reduce with the number of products that you sold. Basically, the economy of scale can be achieved as the variable cost reduced with the increase in number of sales. It includes costs for raw materials, packaging, labor, and other costs that are directly involved in the manufacturing process. And in any businesses, in any operations or small businesses, you want to have what we call break-even point, where at least when you are operating, you want to have the break-even point where the cost of operations is equal to the amounts of profit that you make monthly. Now, the following are the means of how you calculate your break-even analysis. Basically, break-even analysis involves how many do I need to sell to at least cover my costs, and that will be your break-even point, which is fixed costs divided by unit selling price minus the variable cost. And then break-even analysis also involves how much should I sell per unit to make that break-even price, which is the total fixed cost plus the total variable cost divided by the number of units. Now you can do this simple quiz in terms of determining what is the break-even that you need to reach. Let's have 5 minutes for you to think of what are the answers to this quiz. And another one, let's do another one, the quiz of break-even analysis. So let's say a new startup, you have committed a fixed cost of RM1 8,000, and a supplier offers you a product at the price of 6, but you need to buy bulk in 2,000 units. So what is the price that you need to sell the product to reach the break-even? No. The break-even price is defined as the price at which the business is not making either a profit or loss. Selling below that, will cause loss to the businesses. And the total capitals comprise of the fixed capital and the working capital. The fixed capital is the amount of money required to purchase equipment, land and buildings, while the working capital is the amount of money required to produce the product. Those two will make up your total capital. Now, it comes to the second objective, which is the sources of financing. As I mentioned earlier, the sources of financing can come in many forms, but basically they are divided into 5 main categories. Number 1 is the personal savings. Then you have borrowers borrowing money from friends and families, credit cards, suppliers credit, and debt financings. Now, total funds available. To determine the number of total funds available, it's best that you can put them into a proper table so that you identify where are your sources of funds comes from. Now, one of the sources of funds is debt financing. It involves borrowing money, generally in the form of loan from bank or other financial institutions, from commercial financial companies to fund your businesses. Now, there are some advantages and disadvantages involved in it. The advantage are the fact that the bank or the institutions has little say in the way that you run your money. And then the principal and interest are known figures you can plan in the budget. The business relationship between you and the funder ends once the money is fully paid. The loan on the interest on the loan is tax deductible. A loan can be short terms or long terms. However, there are also disadvantages to it, and some of it involve the fact that money has to be paid back within a fixed amount of time. That put pressures on the small businesses. And if you carry too much debt, you will be seen as high risk by other potential investors. You don't want to You don't want to increase your debt unnecessarily. In addition to that, debt can make it difficult for business to grow because of the high cost of repaying the loan. So between debt financing's advantage and disadvantages, you really need to work on the timings or the total time you need to pay back your loans and the amounts that you want to borrow. And this will of course affect your capacity to operate, because a huge amount of your return will go back to your financial.